For more on the broader markets, we turn to Brent Schutte, Northwestern Mutual Wealth Management Company Chief Investment Officer. Brent, good to see you, but downer of a day, man. I mean, what is going on with the market? Shauna points out about 1,000-point drop in the Dow in 2 days. What do you make of it?
Well, I mean, I think we've had a strong quarter to date. So the market was up quite a bit off the October 12th lows, which I think ties into what I think is happening right now. So that October 12th low that we had in the S&P 500 was the day before CPI, at least core CPI, peaked. And so what I think is happening right now is you're moving from inflation fears. That's what drove us lower till October 12th. I think now everyone's starting to see that inflation is moderating. You mentioned the bond market pulling back quite a bit. You mentioned oil at $74 a barrel after being at over 120 earlier this year. I think the market is now starting to worry more about recession fears. And I think that's going to keep us back and forth for some time until we finally figure out that one, a recession, inflation does not survive that. And two, that any such recession that we're going to have would be relatively mild given the state of the consumer. And I'd also point out that we've been having rolling recessions throughout the year. And so think about the goods part of the economy. It's probably already felt like a recession this year because it recovered first. You had a tremendous amount of good spending, and now that's shifted towards services. And so many parts of the economy are experiencing uneven growth. And I think growth overall will continue to slow until we see the jobs market finally crack, and then the Fed will stop.
So, Brent, taking all that into consideration, what does that mean for investors out there right now, given the uncertainty, given the volatility that we will likely see at least for the foreseeable future?
I mean, I think there's good news from the standpoint that bonds now actually represent value. And so if you think about my commentary about the bond market kind of pulling off lately, so the 10-year Treasury was at 424 in October. It's now back down to 350. The Barclays Aggregate Bond Index yields around 4.5% right now. It yielded 175 at the beginning of the year. And so I think if you're a balanced investor right now, that bond part of your portfolio, which let you down this year, will not let you down in 2023 likely because it has repriced. And if there's a recession, rates move lower, that's the side of your portfolio that will do well. On the equity side, continue to do what we've been talking about. Move more towards things that are cheaper. I do think the markets will eventually resume their uptrend, but certainly there's going to be quite a bit of volatility. And the one good thing that investors should always do is never sell when others do. That's usually a path to not having very good returns. And I would encourage people to kind of look through the volatility you're going to see in the next few months.
And direct their action towards what in this environment, Brent?
Well, I mean, we still like parts of the market that are cheap, parts of the market that haven't been loved much for the past 12 or 13 years. And so I've consistently come on the show and talked about hopes, dreams, themes, and meme stocks that were the big things that drove people in 2021. Those areas have been decimated, and things like value stocks have done very well. And I think that's the path forward. The S&P 600, U.S. small caps trade at 13 times next year's earnings. That is not expensive. Even, dare I say, international stocks likely offer some opportunity right now because the dollar will likely not be such a headwind in 2023, and that will accentuate international returns, which trade, the international markets traded somewhere around 12 times earnings. So there are parts of the market that I'd redirect my portfolio to for the next leg up, which I think will occur sometime in the middle of 2023.
Brent, when you take into account, and I noticed that you didn't mention some of those larger cap tech names that we cover so often here on Yahoo Finance, once again, heading lower today. When you try to make sense of when we'll likely see a bottom in some of those most popular names, what's your gauge on that? And I guess what is needed in order to see that sustained catalyst to the upside?
I mean, it's hard to tell. I mean, those companies are definitely good companies and worth owning longer term. I just think they got overpriced and they had demand pulled forward from the impacts of COVID. I think as we push further along into next year, I certainly think they become much better investment opportunities. It's just that we've wanted to tilt our portfolios towards those things that would benefit later, like you're seeing right now. Things that are, didn't benefit from the stay-at-home trade. Things that investors, quite frankly, haven't wanted to own for many years because they didn't do well. I guess the one thing there I would even add to that is if I look at past economic cycles, so from start of a recession to the end of a recession, and then fast forward to the next one. We've had 4 economic cycles since 1981, and each and every one of those had different leadership, market leadership. And I would suggest that this one will be no different. I do think there would be different leaders, and certainly the tech stocks that you mentioned are still good long-term investments, but they're probably not the leaders they were from 07 to 2020.
Hopes, Dreams, Memes, and Themes, buddy. I mean, that is the name of a great album, or at least an interesting album. You said the next leg up is the second half of 23. Between now and then, are we talking recession in your projection?
I guess I say that with a little bit more of a bit less volatility and up and to the right. I still think the market can move higher. I think it's going to be more erratic like you've seen the last few weeks, where we do have some data point come out, people get hopeful, and then the data point gets squashed. I think that's going to be more along the lines of a recession right now. And I think that's going to keep volatility high until you finally have some of those things pull back. The Federal Reserve stops hiking so aggressively, which I think will come as soon as we get a jobs report that is a bit of a disappointment, which I think the labor market is weakening despite the non-farm payrolls last week.
Brent, what about what's going on in the energy market? Taking a look at crude today, just above $74 a barrel, hitting its lowest level that we've seen in nearly a year. Certainly, there's a lot of uncertainty, to say the least, when it comes to Russia's sanctions, the price cap on Russian oil, also what's going to happen with OPEC in the future. What's your view just within this sector and what we could expect in the coming months?
Yeah, I mean, I think the biggest impact that oil has in the economy is from the inflation perspective. And this is why I think inflation stuck around a bit longer than people imagined. We did have the Russia-Ukraine war, which sent commodity prices skyrocketing. Those are now coming off the boil, and oil is a part of that. And so to me, that's a good narrative, not a bad narrative. From the standpoint of overall investing, I still think there's opportunities in that sector of the market. I would not exclude that. But certainly, with oil coming down, that will be a bit of a headwind in the future.